In this video, I'm going to give you some asset allocation strategies that you can deploy in your investment portfolio. Hi, I am Yolanda. I am a wealth advisor, and on this platform, I give you easy, actionable tips, content, and strategies that you can use to manage your money well and build generational wealth. Now, this is part 3 in our asset classes series. In video 1, we spoke about asset classes and the 4 traditional asset classes in South Africa. In video 2, we spoke about your investor profile, why you need it, and the impact that it has on your investment portfolio. And in this video, I'm giving you a couple of strategies involving asset allocation that you can deploy in your investment strategy. Please don't forget to hit the subscribe button so you will always be notified whenever I put out a new video. Also, check out our other platforms on social media. It's Financially Fabulous Females, and you should also check out our brokerage page on Facebook, Solomon Wealth Management. Also tune in every Monday on the Wealth Nation podcast, iTunes, on Spotify, on Amazon Music and Deezer. Every Monday we release a new audio podcast on all things financially related from a South African perspective. So today we're talking about asset allocation. So if you don't know what an asset class is, click this link here and it will take you to video number 1 that explains the various asset classes in South Africa. So asset allocation strategies are basically based on your investor profile. More info on that here, and how the two link up and how we should be allocating our assets based on our investor profile. So when it comes to these various strategies, it's basically the way we spread out the 4 traditional asset classes based on our investor risk profile. So the theory is that an investor can lessen the risk by having a blend of the 4 asset classes based on his profile. For example, when shares begin to rise, traditionally bonds begin to fall. And at times when the stock markets begin to dip, traditionally the property markets begin to rise. So the total amount of the investor's portfolio placed in each asset class is done by an asset allocation model. So these strategies are aimed to achieve the goals of the investor based on their financial goals and also based on their risk profile. For example, a single adult that is approaching retirement is more concerned about preserving their wealth rather than making big gains in the portfolio, because high rewards usually are attracted by high amounts of risk. Whereas a young couple straight out of university, they have plenty of time in the market. They are willing to stomach the ups and downs that the market might have to offer, and their asset allocation strategy will be very different to what a single person nearing retirement would be seeking. So the first model that we're looking at is the capital preservation model. So this model suggests that we use a blend of the asset classes that is aimed at preserving capital. Some of the asset classes that do that are 1, bonds, and 2, cash, mainly because these 2 asset classes bring about slow and steady and secure forms of income in the form of interest. So investors that are usually planning to make a purchase in the next 12 to 36 months usually deploy this strategy. For example, you're saving up for a home, a car, you're getting ready to buy a business. You can't afford to lose any bit of your money. You want your money secure. You want your money to be preserved while getting whatever gain it can without much of the risk. And here as well, you want to be in the cash asset class. You want to be in the bonds asset class. The biggest downside of this model is that the gains that you could get does not keep up with inflation, and that could be a big deterrent. Then is the income model. This is designed for investors that are looking to build income, such as people that are in retirement that want to preserve their capital but want to use that capital to generate that income during their retirement years. So these type of investors usually look for cash, they look for bonds, they look at REITs because REITs give them nice rental returns. If you want to know more about REITs, check out this video and that will give you a nice idea of how REITs work in South Africa. And REITs have to pay 70% of their rental collections according to the law. So a typical retiree would be very income driven. Also a single parent, maybe they received a nice insurance payout due to a spouse's death. They would be looking to preserve the capital and to get income to to finance the children's lifestyle at this stage. Then you have the balanced model. Now, the balanced model is more concerned with striking a balance between long-term growth and capital preservation and current income. So the ideal mix in the balanced model would be to generate some cash as well as appreciate over time and allow a segment of that portfolio to grow. So a balanced model would seek to have a balance between equity, a balance between bonds, where the equity is the growth drivers in that portfolio and the bonds that bring about the stability and the income. Then there's the growth model, and growth is big on just expansion. And the asset class that does that is equities. And although it's very volatile, it's very up and it's very down, a growth model portfolio is focused on a very high equity exposure to bring about that growth. And the investor is not really worried about the short-term volatility that the market offers, but they have a longer-term vision, a higher investment horizon in terms of length. 10, 20, 15 years, they're willing to be in the market to stomach the growth, but to have that long-term growth in their portfolio. Now, one of the risks of having a growth model is that when the market is down, this model is the hardest to be hit. However, when the market is peaking, this is the portfolio that is shining. So this is the portfolio that's highly invested in shares with little exposure into the other asset classes. And a lot of times, most of these investors are looking offshore to get some real growth. Now, depending on the type of investment that you're in, whether you are in Regulation 28 funds, retirement funds, you can't get that offshore exposure that you need. Whereas tax-free investments, you can go all out aggressive into international equities. So as investors go through the life stage, they go from university to young parents to teenage parents, empty nesters, and then into retirement. The goals change at the various life stages. The investor profile changes at the various life stages. And this is why there is value in sitting down with your investment advisor annually to realign your goals, tweak your portfolio where it needs tweaking, and to make sure everything is aligned in terms of reaching your financial wellness. And if sitting with your advisor, not taking a deep dive into portfolio, if it's something that you haven't done, now is the time to do it. So reach out to your advisor and take an in-depth look at what you're exposed to in terms of equities, bonds, property, or shares. Property has performed dismally in the country, and if your portfolio is not making money, it could be heavily exposed to South African property. So go and check. Don't just say that so-and-so company is terrible because my investments are tanking when you don't really know what's in your investments. So take that time now that you've gone through, hopefully you've gone through the 3-part series. If not, click that link, go through the 3-part series, understand asset classes, understand your investor profile, and use the strategies I've discussed in these videos to try and rebalance your portfolio so that it meets your investor risk and the asset allocation as well. So if you're looking for some financial advice, you're looking for a critical eye to review your investment portfolio, click that link down below and reach out to us at Solomon Wealth Management. We will gladly assist you.